Sunil Subramaniam, good morning. Thank you for joining us. It rained in Delhi yesterday. It is raining in Mumbai. What is happening in Chennai?
Rains are quite far away, and even the COVID situation, the number of cases is still rising because of our super spreader vegetable market. But otherwise, the city is coming back to normal in terms of activity. So you can see, offices are being opened. We are also taking a call with limited staff at our office. So I think life is slowly coming back to normal because people have come to terms with COVID. I think I was just hearing what you were saying, Nikunj, about the change in view. And as you know, from my views on this channel, I've been one who's been consistently on the bullish side of things from a longer term perspective. And I think that what you said was perfectly right. Plus, I think that there's a conscious thing of coming to terms with the crisis. I think that's an important factor one mustn't forget. Because when you're dealing with uncertainty, right, you don't know how bad it's going to be. But now we know that these are the cases that we have localized it to pretty much 3 or 4 states or regions in India, right? There's Maharashtra, Bombay and Pune, there's Gujarat, there's Tamil Nadu with Chennai in the lead, and there's Delhi. So if you take these kind of clusters, right, the rest of the country, and if you see, while they say that rural India agriculture contributes only to 16% of our GDP, and so it won't help much, the key point is that a lot of our manufacturing facilities are located in rural India, the factories. So that factor, I don't know how far our data really captures the contribution of Bharat in terms of the manufacturing, in terms of each company. If you segregate out the plants which are in industrial belts like Pune, where it is clearly affected, versus, let's say, deep down like a Bhandup or something else. So I think there's a lot of stuff here which the researchers, and still look at it, we have to pat ourselves on the back on the medical response. Our total number of cases, right, is just about 20% over the number of deaths in the US. Just look at the contrast. We are the second largest or the first largest, most populous country in the world. We are about 7th rank in terms of the cases. So clearly, vis-a-vis the country and the population, I think we've done a fairly good job. I know there are pockets like migrants who've gone back, not coming back. Second thing on the stock market, because the other aspect why the stock market is reacting positively is because a lot of the impact is going to be passed on to an unorganized non-stock market sector. And if you see who will recover fastest, everything, it'll be those bigger companies. And I'm telling you, even a micro-cap company is among the bigger companies because there's a huge world of non-formal, unorganized sector sitting there where the heat will be fed, where will take some time to come. But these companies, which are listed in the stock market, are the creme de la creme of the country. They are the ones who are going to be able to cut costs, pass on the burden. So I think that's where the stock markets are also positive. Sorry for a very long reply, but I just thought I'll use this opportunity to put down my thoughts here.
Okay, Sunil, it's good to be optimistic. We both love to be optimistic. Optimism has helped you. Optimism has helped me in life. So I'm not taking away the undertone of optimism. But where does one really get more realistic about what is happening around us? Which is that Nifty is at 10,000. Economy is going to contract. We had a 4% GDP growth for the quarter gone by, and COVID has happened in this quarter. B, there is serious unemployment which is getting created. We know that FY21 will be a washout year. Till how long do you think markets will remain immune or Teflon coated to what is happening on ground? On ground situation is bad. It is unlikely to improve in next 2 or 3 quarters. But the way markets have galloped from May's low or March's low of 7,500, it appears that somewhere markets believe that forget a U, forget a W, it's going to be a V-shaped recovery.
No, I think the answer lies, Nikunj, in the component of long-term money versus short-term money. You see, so if you see the correction in March, I think it was a lot of ETF money, retail money, which while technically long-term, as retail is sentimental money, right? People feel bullish about emerging markets, they put money into emerging markets. So they pulled out. So they're the ones who normally go out first and they come back also first. The second is that there is consistent long-term money out there in the market. You saw, see, this year we have seen that compared to the previous global crisis, we have had 3 times the amount of liquidity pumped in. And there's about $3.5 trillion worldwide sitting in money market funds, waiting to come back to equity. And if just there's a move to the median, right, it's $2 trillion of money waiting to come back. Now, all of it will not come back in a lump. So what happens is that when somebody has a 5-year view, let's say a pension one which has a 10-year view, let's say a mutual fund with a smaller cap exposure, I will naturally have a 5-year view in most of the stocks I buy. When I look at it from that perspective, this quarter, I am actually discounting something like 9% negative GD growth this year in my calculation, Nachun. So what has happened in my portfolio, for example, I can share with you, is that we have moved to from an earlier positioning. On a normal scenario positioning, we were roughly, if I may say, across our portfolio, 50-50 in terms of a long-term growth-related risk outlook and a short-term safety-oriented defensive outlook. Okay, this was because Indian economy itself was just chugging along, not great, prior to the COVID crisis. When the COVID crisis came, we first shifted to a 60-40 favor safety, then we shifted to 70-30 favor safety. Now I'm coming back from 70-30 to 65-25. So all I'm trying to say is that, yes, safety is an important aspect. The stock market has been helped in the short term by some safety-related exposures, like pharma is viewed as safety right now, IT to some extent, basic consumption, FMCG to some extent. But there is also, you see, auto index has gone up. There's also consumer discretionary is going up. So there is a shifting of reallocation within that. And reason the markets are kind of that stable. You're again saying, why are they not discounting the bad news for the remainder of the year? The fact is the March 30% correction actually, in a way, discounted all of that. Because there was an overreaction because liquidity was drying up. ETFs were pulling out money. Mutual funds were buying in March. It is the mutual funds who started selling from March. If you see financial year to date, Indian mutual funds have been negative. They have been selling. But FII flow, Nikunj, important point. Financial year to date, FII flows of all the major emerging countries, India is the only country to have positive FII flows and not a small amount. You know the data you have with you all, right? This huge amount of money, FI money coming back. Why is it coming? My version here is that it's the longer term money, which is saying I am getting these stocks cheap. And I'm not worried on, I might miss another 10% downturn because the market in the next few months is going to discount a even greater drop in GDP as the real numbers come out and all of that. I don't mind. I'm getting it a bit 10% expensive compared to my long term, but I've already had a 30% correction in March. So I'm still getting it at a 20% discount to a long term and buying at a reasonable price, growth, GARP, right? Growth at a reasonable price. Always remains the fundamental tenet of stock market, and a long-term investor will go by that. And when I know that a company might have a short quarter because of this impact, but its long-term business model is not going to be shaken. Let's say I give them 2 quarters of negative growth this year. I give them another quarter, wait for the migrant labor, unemployment, all that to come back. And so let's discount this year. When you come to April, May, June 2021, Nikunj, you're going to look at whatever recovery happens as YOY over April, May, June this year, which is probably the worst quarter in the history of the Indian stock market. So anything you compare with that, YOY, April, May, June, is going to look fairly good. And the market, given that it's a lead indicator, will discount it a little ahead of time. No, I'm not saying that you do it 6 months ahead, 3 months ahead, but that April, May, June next financial year, that first quarter of the next financial year, I think is a very clear signal where the YOY effect will come in and help everybody believe that the V-shaped curve, as you know, I've been a proponent of this particular crisis, the recovery being V-shaped, whether it's an economy or it's in the stock market compared to the GFC. And the reason for that is that was a demand-oriented crisis. This is a supply-oriented crisis. All the unemployment, labor, companies shutting down. So when those come back to normal, I believe that we will see V-shaped recoveries in both the economy and the stock market. And arguably, the stock market's V will turn ahead of the economy's V. Because I'm a firm believer that the collective wisdom of hundreds and thousands of analysts all over the world, studying companies, studying sectors, will give them a clue to that actual economic recovery, the actual GDP growth, the actual EPS growth, well before it actually happens. So to me, to answer your specific question in terms of the market is not reacting to it, it's because the market is already saying the worst in terms of forecasting is behind us. There's already a 9% GDP growth forecast for this year. Are you going to say 9 is going to become 15% negative GDP growth? Market is saying unlikely. So a 9% negative GDP growth for this year, I think, is the worst of the cases, which is what we as a portfolio managers have factored in and accordingly done the safety. I'm not saying that you're going to put everything into risk today. Yes, as I said, even today, we are attempting to move 60-75% in safety, but it's important to have that 35 to 40% in the longer term risk.
Sure.
And here in risk, I'm saying, everything that is linked to economic growth.
Right. Sunil, great to have you on the show today. Thank you so much for taking the time out.